Join us on Winning Strategies. We're going to be talking about tax efficiency. We're going to be talking about changes in the industry and how you can be a differentiator in your marketplace. Also, we're going to talk about how to increase the value of your business by talking about tax planning, which will separate you from the rest of the competition. One of the best things that you can do for your client's beneficiary is to help them harvest the cost basis. It's a benefit to your actual client who needs income right now, but the real benefit is for the beneficiary. And if you can capture all of your client's beneficiaries, then you've doubled your business and created more sustainability in your business. Here's what I mean by harvesting the cost basis. There are some great and innovative income writers out there today that allow you to start income and have an exclusion ratio, just like you were using with a single premium immediate annuity or a non-qualified deferred income annuity, so that part of your income every month is a return of basis and is returned to you tax-free. That's a huge advantage for every American because your income is much more tax efficient because you're getting your cost basis back. But the real advantage is that when your client passes away, that your beneficiaries can now go in and harvest all the cost basis. They can go in a single lump sum and get the rest of the cost basis, and they receive that money tax-free. Or they can start a monthly income that will be all cost basis until they exhaust their cost basis. And I will guarantee you that if you explain to your beneficiaries that you're putting them at the front of the line and putting the tax man at the back of the line, you will win those beneficiaries as clients, and it's a great way to double your business. It's a huge advantage for every American because you get an exclusion ratio on your income. What that means is that every little bit of monthly income has a return of the cost basis, which you receive completely tax-free. That makes your retirement income portfolio much more efficient. You're delivering value to your clients by making their retirement income much more efficient than any other of the competition. We've seen phenomenal growth in the United States economy, and a lot of economists believe that is due to less regulation, but also the recent tax reform, and I would agree. There are a lot of positive things that happened in the tax reform that was introduced in January. However, there are a couple things that bother me about the Tax Cut and Jobs Act of 2018. One is the effect of charitable contributions. What's happening with the tax code is that most people will not be able to do itemized deductions anymore because everyone's standard deduction went up to $24,000. And that's great from a tax planning standpoint, but most people do not write more than $24,000 of charitable deductions. And so that will cut a lot of deductions out. In fact, most people, most Americans, only about 5.5% of taxes paid will end up having itemized deductions in 2018. So most charities will be largely impacted by this because most people will not take a deduction because of the standard deduction. That's going to hurt a lot of charities in terms of how much they actually are able to receive. One of the things that you're actually able to talk to your clients about that still have philanthropic tendencies are qualified charitable distributions. What those are, they're called QCDs, basically is your required minimum distribution all the way up to $100,000 per year can be directed directly to a charity. That will be a non-taxable event. It's not a deduction, it's just not included in taxes. So it's a great way to be tax efficient. It's also a great way to hold down your modified adjusted gross income and your combined income. Those two thresholds affect your Social Security taxation as well as your Part B Medicare premium. So if you're able to depress your income because you're eliminating your required minimum distributions while still helping charities through your philanthropic tendencies, you have a great opportunity to combine the qualified charitable distribution with your income planning and make your client's income portfolio more efficient. In a recent survey, Americans are concerned about a lot of different things relative to their retirement. 52% are concerned about their highest marginal tax bracket. 71% are concerned about how to pay for health care costs and how to actually obtain health care costs in retirement. But 81% of Americans are concerned about outliving their income. So we have to get back to income planning like we talked about a little bit before. But one of the biggest issues in income planning is to making sure that it is tax efficient. Today in America, people really do not value asset allocation services. You can get that through a robo-advisor. You can log on to Fidelity or Schwab or any one of the discount brokerages, and you can do your asset allocation for as little as 14 basis points in cost. You can do rebalancing and everything. That's how we built our assets under management and our wealth management businesses. Unfortunately, we're missing the mark. What clients will really pay for is tax planning, and tax planning and income planning during retirement. They value that as much as 100 basis points. So if you're looking for a way to increase the value in your business, to be able to provide more value to your clients that they are more than willing to pay for, think about talking about income planning and talk about how to incorporate tax planning into that. Those two things will really add value to your planning fees, which will ultimately increase your revenue, and that will increase the value of your business. One of the things that a lot of advisors make a mistake on is they talk about planning on gross income. So when our clients come in, they say, I want to retire. We take a look at the nominal income. We have to really break that down. And one of the things that we need to focus in on is net income. I always tell people it's not what you make, it's what you keep. And so we need to really evaluate the impact of the taxes, the distributions, whether they're capital gains, ordinary income, and where can we figure out how to keep our income under the appropriate thresholds so that we can still afford the medical care and the medical premiums through Medicare Part B. One of my biggest concerns of our industry is that we've spent the last couple years focusing in on rates of return and locking in our clients' wealth. And that's great. We've protected a lot of wealth. But nearly $30 billion of annuity sales has left the industry. There's not a corresponding bond fund, cash flow, or equity fund cash flow to make up that difference. So when you think about the impact of income planning, we're losing $30 billion of income assets, income producing assets. Part of that has been that we've been really focused in on locking in gains, making sure that our clients' wealth is protected, but we've lost one of the biggest benefits of annuities, and that is the value of guaranteed income. We can show study after study of the benefits of guaranteed income. And I encourage all of you to think about how to encourage your clients to get back into focusing in on security and guaranteed income for retirement, because it can really increase their confidence level. Here's a couple ideas for you. First of all, really think about using single premium immediate annuities as well as fixed indexed annuity income riders. Now you may be thinking that in today's low interest rate environment, and as we record today, it's still under 3% for a 10-year treasury and has been for about 60 months. You may say, Mike, that's the terrible time to buy an annuity. I would argue that it's the absolute best time for long-term planning because you maximize your exclusion ratio, which that exclusion ratio is the percentage of money that you're going to get back tax-free on a monthly basis. Because interest rates are low, if you start out on a monthly income, you're going to be able to get more after-tax income in a single premium immediate annuity. Also, we have to get away from the biases with home equity conversion mortgages. They're no longer just reverse mortgages. The HUD has actually made it more favorable for clients using reverse mortgages. Set up a line of credit, but tap into the equity in your home. It's a valuable asset for retirement income planning. And finally, the use of non-correlated assets has really lost in the life insurance industry. We have to get people buying permanent life insurance, whether it's indexed universal life, whole life, or universal life. The ability to tap into tax-free loans using life insurance can really create another source of non-correlated assets. This allows your portfolio to be able to be insulated a little bit in times of different market negative conditions. When we take a look at our studies, we actually decreased failure rate from 26% using a systematic withdrawal down to 2% using cash value as a non-correlated asset. So I really encourage you guys to take a look at some options with guaranteed income and non-correlated assets and really get back to talking about what Americans are concerned about the most, and that's outliving their income. I hope you've enjoyed these ideas. I know that these ideas will really help increase your business revenue, but also help you get closer to those beneficiaries and add more clients. For more information, check the links below for additional resources from Ash Brokerage. Don't forget to follow me on Twitter at McGspeaks. Connect with me on LinkedIn, subscribe to our podcast, The Winning Strategies Podcast, and don't forget to subscribe to the Ash Brokerage channel on YouTube. Good selling.